Now in this video we will project the financial statements for the next 5 years. We have already completed all of the assumptions that were necessary for the projections. So let's start from the beginning. First of all, we need to complete the supporting schedules so that these values can be used in further calculations. So first of all, let's predict or forecast the value of the account receivable. Since we have calculated the receivable days, so if you multiply receivable days by sales and divide by 365, means this is just a reverse working of the same formula, so you will get the amount of the receivable. So what we will do, we will just multiply the sales, which is this cell, which we haven't calculated it, but we will calculate it further, and then multiply that by receivable days. Receivable days we have already calculated, it was 18, and divided by 365. Okay, and then the inventory days. Okay, let's calculate the sales first because we will need that value in calculation. So equal to previous year sale times 1 plus the growth rate, and growth rate we have already calculated, that is 10.32, and that's it. We get the sales. Now cost of goods sold, and we can project it for the next years like control R, so it will automatically take the next cells. Now the cost of goods sold is the percentage of sales. So percentage of sales is 38.5. So 38.5 of sales, which is this cell, and we need answer in negative because we will subtract cost of goods sold. So this is cost of goods sold, we fill it to the right, and for this one we will just fill it to the right because we have already done the calculation. For the totals we can just fill them to the right in advance, and also these ones, so that the sum calculation is carried same as the right side. But make sure these are not the hard-coded values, these are formula. If any value is like filled to the right, then it will be copied. The same value will be filled instead of the next cell value. So we will fill that to the right, and also this number, all of the sums. Also the check, so that if the cash flow is not balanced we can check it. Net working capital, changes in net working capital, and closing value of PPE, then the closing value of debt, closing value of equity, closing value of retained earning, and so on. Okay, now let's go back to the forecasting section. Salaries and benefit. So for salaries and benefit, we assumed that it will remain fixed, that is dollar value, which is 24240. That is the average of previous 5 years, and we also fill it to the right. Then and overhead rent and overhead are also there, this one, and we also fill it to the right. Then we have depreciation and amortization. For depreciation we have to calculate like the percentage of depreciation to the opening value of the equity, or opening value of the asset. So for this we need to complete the property, plant and equipment schedule. So the opening value of PPE will be the closing value of last year, and we fill it to the right so that each year's closing value becomes the next year's opening value. Then the capital expenditure are here, and we need them in opposite sign, so we will write minus. Now these are the capital expenditures, they will be added to the fixed assets, and then the depreciation is opening value of PPE times a percentage that was 40.48. Now we fill it to the right, and we need this to be negative, so I will write minus sign here, and then we fill it to the right. Okay, so we have the closing value of PPE, we have the depreciation, we can fill these values back to the income statement. So depreciation equal to, and then the value of depreciation that we just calculated, it was this, and I also need the opposite sign, so I will write minus here, and we fill it to the right. Then we have the interest expense. For interest expense, it was just some percentage of opening value of the debt. So let's complete the debt schedule. The opening value of debt will be closing value of last year, and we fill it to the right. Now the issuance and repayment. So issuance or and repayment is this. We are paying 4,000 each year on average. So if we scroll it to the right and fill it, so we will get the closing value of debt. You can see each year 4,000 is reducing. And now the interest expense. So interest expense is the some specific percentage of the opening value of debt. So equal to opening value of debt. Opening value of debt is here, times interest rate, that is 3.8%. We can see it here. So this is the interest expense, and now I will take that value, means I83 here, equal to I83, and fill it to the right. So these are the expenses, and we fill it to the right to get the earning before tax. And then we find the tax rate, so equal to earning before tax times the rate of tax, and the rate of tax we calculated, it was 29.43. Now we fill it to the right, and we need these values in negative, so I will just write minus sign before it, so that all the tax values are in negatives. So we got the net earnings. Now the cash value can be obtained from the cash flow statement, so we will skip that. Receivable, we have this value, we calculated in the working schedule like here, and I will fill it to the right. Okay, now the inventory. Okay, so let's complete that working capital schedule, which was incomplete. Okay, it's here. So now inventory will be just cost of goods sold, so we will take the value of cost of goods sold, which is this, times inventory days, which was 73, and then divided by 365. So we got the value of inventory, and then same we fill it for receivables. And now for payables, we will just divide the value of payable. No, we will just multiply the cost of goods sold by the value of payable days. So the value of cost of goods sold is this number, times the payable days divided by 365. We fill it to the right. Now rest of the values have been completed automatically. So let's fill these values, and now let's see what's left. The value of inventory. So the value of inventory was here, and then we have property, plant and equipment. So the property, plant and equipment schedule, I guess we completed it there. PPE schedule, PPE closing value is here, and then we fill it to the right. Okay, now we have the payable value. We found payable value here in the debt schedule, and we fill it to the right. And then we have the value of debt. The closing value of debt is this one. And now the equity value will be in equity schedule. It's here, and we fill it to the right. Then we have the retained earning value equal to and then shareholders equity value. Fine. So let's complete this the equity schedule, or let's take the net earning value from the income statement. It's here. Then we fill it to the right. Then the depreciation value can be taken from the income statement here. And then changes in working capital, we will take it from the supporting schedule. It was here, and it was supposed to be subtracted, so I will write the minus sign here because rest of the values are being subtracted, so that's why I will fill it to the right. And now we have the investment in property, so that was the capex equal to minus and the capital expenditure. It's here, and since the minus sign is already there, so I will not take negative sign. All right, and then issuance and payment of debt. It should be in the debt schedule, like here. And payment of equity, there was no payment of equity, but we should link it. And now we have the increase or decrease in cash. We will just scroll it to the right, and then the same cell, which is opening value of cash. Okay, so opening value of cash is actually the closing value of last year. So we get the same values here. Now let's see what's left. Opening value of equity. So closing value of last year will be opening value of current year. And then equity issued from the assumptions, which is 0. And then the opening value of retained earnings. So closing of last year will be opening of current year. And then the net income. So net income is in the first cell. It's here. It hasn't typed there. Okay, why is it not typing? Add net income. This is the closing value. Okay, now it shows the answer. Maybe there was a lag. Okay, now we scroll it to the fill it to the right, and then the closing value will be just this cell, add this cell. So this is how we complete the balance sheet and income statement, but still we have some errors. Let's figure them out. Okay, so let's recheck if something is missing. So first of all, we have revenue and the cost of goods sold. We subtract it, we get this number, and then these are the four values. We add them, which becomes 51,289. But this sum is different from that. Let's see why. Okay, so this is earning before tax, so obviously this is supposed to be different. And then we have the taxes, net income, fine. Okay, the cash value is missing from the balance sheet. So let's take the cash, closing value of cash, this is here. And now we fill it to the right. So you can see the total assets and total liabilities are equal. Even I can just fill it to the right. So there is no error. All of these values are okay. But if I delete any value like this one, so you can see I will get the error in balance sheet here. So all the values are balancing. That means we have successfully forecasted the next 5 years balance sheet and income statement and cash flow statement. So that's it for this video. See you in next video. Thank you.